In this video, we're going to discuss several advantages of standard costing. So first, let's be clear about what we even mean by standard costing. So at most large companies, the top management would set standards that it expects the managers to meet. For example, it would say, okay, here's the price we should be paying per pound of raw materials, or here's how many pounds of raw materials we should be using to create 1 unit of our product. They could also say, okay, here's the price or the rate we should be paying for direct labor. We could think about the rate for the variable manufacturing overhead and so forth. So we set these different standards that the executives would say, okay, this is the price per pound. We've talked about it. We think this is a good price per pound that we should be paying. And then they can compare those. They can compare those to actual operating results. At the end of the period, say, okay, so we set these various standards. Let's compare them to the actual results and see if we met the standards and where we fell short. So that's called variance analysis. A variance is basically just a difference. When we talk about a variance, just think of a difference between what should have been and what actually happened. And so we can do this variance analysis. We can calculate the price variance for raw materials. We can do a quantity variance for raw material, all these different variances that we can calculate. And the variances serve as benchmarks to the managers. Let's say, for example, you are the purchasing manager and you are trying to figure out, okay, I'm the purchasing manager. I need to purchase raw materials. And you have been told by top management that you need to pay no more than $7 a pound for raw materials. That's giving you a pretty clear target of that you shouldn't be paying more than $7 a pound. Now, there could be a situation where top management doesn't realize it, but there's actually been a spike in the price of raw materials and you have to pay more than $7 a pound or so forth. But whatever the case, this gives you an idea. This gives you a benchmark of, okay, this is what I should be hitting, or at least this is what the executives expect me to be hitting. Okay. Now, if you don't hit that amount, if you end up, let's say, paying $10 a pound or something, then you'll end up with an unfavorable variance. Okay. So when we have an unfavorable variance, it's really just a red flag to the top management. Okay. So think about somebody who's the CEO of a multi-billion-dollar corporation, and they have all these different costs, and they can't look into and investigate all of them. They just don't have the time. So what they could do is they go set up with all the variance analysis and say, okay, here's an unfavorable variance, here's a favorable variance, and so forth. And they could just pick out the largest ones. They could just say, okay, here's a really large unfavorable variance, here's a really large unfavorable variance. Let's investigate this, let's investigate this. These other ones are kind of small, let's just forget about them. And so we could just kind of save time for top management. They can just look at, try and identify very quickly where there are serious problems. Okay, and that's called management by exception. Is basically if everything's going fine here, doesn't look like there's a big variance, we just ignore it. We don't look into it. We just want to go and look where there's a big problem. Okay, so that's management by exception, and you can do it because of variance analysis. It basically saves time for the top management and allows them to very quickly look through and see where there are issues. And it also is standard cost and variance analysis allows the company to practice responsibility accounting. So the idea behind responsibility accounting is that a manager should only be held responsible for the costs that they actually control. Okay, so let's think about supplies at a hospital. And so we think about these supplies, and we could come up with a spending variance and say, okay, here's what our actual supplies expense was, and here's what it should have been per the standard. And we call that a spending variance. But you can actually break it out when you get really into variance analysis. You could break it out in finer detail and say, okay, what's the actual amount? So this spending variance, let's decompose it and say, what is the amount that had to do with us not paying a good price? Let's say, for example, with this supplies, we had the spending variance was, let's say, 70,000 unfavorable. Okay, now we say, okay, how much of this 70,000 unfavorable was due to us paying more than we should have paid for the supplies? And how much of it is a quantity variance, which is saying we used more supplies than what we had said we were going to use? Okay, now this is very important, figuring with this. So first of all, it's important, obviously, just to have the variance to see, okay, there's an issue here. Why is the supplies expense so much higher than what we thought it should have been? But it's even more important to go and say, okay, let's drill down and see, is it because of the price, we paid too much, or we used too much? Because with this responsibility accounting, we want to go speak with the manager who had the authority over why this 70,000 is unfavorable. So if it's because, for example, let's say it's because the price, we paid too much, and it has nothing to do with the quantity that was used, then we would want to speak to the purchasing manager, right? The person in charge of buying the supplies. And it's not necessarily they did something wrong. Again, it could have been a shock in the industry, and the price of supplies skyrocketed, and the purchasing manager had no control over that. But it could be that the purchasing manager isn't getting a good deal or something like that. But whatever the case, if we drill down and see that there's an unfavorable price variance for these supplies, we would want to speak to the purchasing manager. We wouldn't want to go and talk to the person in charge of using the supplies and say, hey, what's going on? Why do we have this unfavorable variance? Why was our supplies expense? Because they're not responsible for it. The person responsible for the usage of the supplies has no control necessarily over buying the supplies, right? Assuming it's not the same person, right? Usually these are different roles within an organization. So if there's an unfavorable variance due to the price and us paying too much, responsibility accounting says, hey, common sense says we should go over and talk to the purchasing manager to try and investigate and find out what the issue is so that we could solve it going forward.